any regulator in DC right now, when they look at any marketplace, they have these certain guiding principles that they always look for. Operational capability, competition, and also disclosures around it. When you apply those three principles to the options marketplace, the regulators probably are under operational capability, looking at areas such as the proliferation of strikes, in the areas of competition, which by the way does add a lot of resiliency to the system. If one venue goes down, you have an option to route to another venue. If a broker-dealer goes down, clients have the ability to move their funds to another broker-dealer. In the areas of operational capability, they're looking at obviously the strike proliferation. In their competition, they're looking in areas such as the lack of number of clearing firms, looking at the number of exchanges and also the number of market makers. And then in the area of like disclosures, because we do have a disclosure-based regulatory regime, they're looking at our investors getting the information that they need to measure best execution.
How do policymakers balance investor protection with liquidity and spreads?
Payment for order flow has been a hot topic down in DC for the longest time. It's been debated around it. Most of them are looking at it from the perspective of they kind of ask themselves 4 questions around any type of conflict, whether it's payment for order flow or anything else. The first question they ask is the conflict being disclosed, which in payment for order flow it is on the account opening process and also on the confirms. Does the investor have the ability to see if their broker is dealing with the conflicted venue, which they do through 605. They also kind of ask, does the investor have a choice to deal with a broker that isn't accepting payment for order flow or isn't acting in any type of conflicted way? And they do. Investors do have the ability to open accounts at broker dealers that either don't accept payment for order flow or even provide the option to have their order go down a different pipe on it. The fourth question is the one that they have the hardest time with, and that is, if we just remove the conflict, are investors better off? There are, large sums of money that are being, through payment for order flow, that money is being used to invest in very dynamic platforms that obviously are providing a value to investors. So I think that's where they tend to struggle.
Do you expect regulators to push for consolidation of the 18 options exchanges?
Fragmentation is a byproduct of competition. Right, you have a competitive marketplace, you're going to have multiple service providers, whether it's an exchange or a broker-dealer on it. The question really is is there too much fragmentation, right? And I think the first thing that regulators look at in a situation where there is fragmentation, especially at the exchange level that you talked about, is there connectivity between the different venues. They can't have a fragmented marketplace where there is information or prices available in one venue and you're on a different venue, you can't see the information, you can't transact there. So I think that box, I think they check that they do feel that there is very good connectivity between the venues on it. However, fragmentation in one area in the marketplace does lead to costs and frictions in other areas of the marketplace. I think that they are going to look at this area, and I think they're going to look at it from the perspective of what are they doing to cause fragmentation. And I think they're also going to look at it from what are we doing as in our rule set that maybe one marketplace is concentrated that maybe could be fragmented a little bit more. So I think they're going to take a more holistic approach about it. I don't think they're going to ever say 10 is the right number, but I think they are going to do more of a self-evaluation as far as what their role is through their rule set and the fragmentation that's a result of that. Is it providing a benefit?
Are regulators focusing on systemic or investor protection risks regarding zero DTE?
Regulators have been at the table on this conversation since day one. All right, so they are familiar with the product. They are familiar with the risks with the product, in particular around unexpected earnings announcements around it. Second, they continue to engage with the industry on the topic, whether it's through roundtables, one-on-one meetings, or publicly available information out there. I don't see them doing anything draconian in the space, for lack of a better term. Congress set up the SEC and all the regulators to be disclosure-based and not merit-based.
How is the regulatory community addressing stress testing, margin adequacy, and default management?
I get asked that question, what keeps you up at night? It is around the clearing, the concentration of clearing firms in the space. I think everyone obviously agrees that the old way of end-of-day pricing, end-of-day batch activity, using those numbers to calculate margin for the next day, those days are gone. that there's a lot of technology being thrown at this as far as measuring intraday activity, intraday calculations. But there is more that needs to be done here from a regulatory standpoint as far as how can we make this marketplace operate in such a way that the capital that we're collecting, because you have to collect money, right? You have to collect the capital, but is it the proper amount? Are we measuring it properly intraday? And that it's not causing some type of friction or bottleneck where the money could be spent elsewhere.
What conversations are happening regarding investor education and measuring retail trading outcomes?
When the regulators and congressional members look at those three topics, I think they're bifurcating it into two buckets. You know, the one bucket is the individual investor using some type of a financial advisor or an intermediary, or are they doing it on their own? With regards to suitability, obviously, as an individual investor, if I'm relying on a financial advisor to recommend products to me, I'm relying on him to make sure that they are suitable for me. I don't expect the same when I'm doing it on my own. In the areas of research, you know, and education, if the financial advisor is providing me with research reports, I want to make sure they're not conflicted. In the areas of, if I'm dealing on my own, I just want to make sure that the models that I'm using to test my own knowledge in the skill set will actually operate in a real world environment. And as far as measuring, you know, am I better off? How are things going? Well, you know, if I'm dealing with a financial advisor, he's going to provide me with a very robust report at the end of the year, how I did versus similar types of investors like myself and using similar products. And then on the other side, as far as you know, how regulators and congressional members are looking at are investors better off when they're on a self-directed platform, I think the only thing they're really kind of looking at right now is really just the growth of that marketplace, and that if it's growing, the experience there, people must be getting a good experience.
Do regulators view outcome ETFs as democratizing access or as products requiring additional scrutiny?
I think regulators are viewing outcome ETFs as a continuing evolution of what ETFs started to bring to the marketplace in 1993 when they first came on the scene. It is a democratization for investors to have access to these types of portfolios. As far as inherent risk, there are some inherent risks that are different in outcome ETFs, given that there is an option in the ETF. But that seems to be being managed properly on the back end. At the end of the day, this really is going to be measured on, is the ETF, the outcome ETF, providing the outcome that it you know, claims to be providing.
How will the interplay between U.S. and global regulatory regimes shape options markets?
As an industry advocate, you know, I want the best of everything, right? I want us to have the best exchanges, the best broker-dealers, the best vendors, and we also want to have the best regulator. If you're going to get institutional-sized money, they want to be in a marketplace where they know the regulation is efficient and it's good. And you know, we also want to have the best legal system. While there may be areas where regulation is different than ours, maybe it's a little bit looser, I'm not fearful that we lose money because money goes to a less regulated place. I think institutional-sized money wants to be in a marketplace where the regulation is the best.